2 p.m. in New York, at 6 p.m. in London, live from Bloomberg World Headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs.
And it's a rout to start the week. The S&P 500 on track for its biggest drop in 7. That's as COVID cases fuel investor nerves with no stimulus to ease them. Energy, industrials lead the way. The dollar and treasuries, your haven of choice. Meanwhile, Beijing sanctions U.S. defense contractors. China taking aim at Boeing, Lockheed and Raytheon following U.S. approval of a $1.8 billion arms sale to Taiwan last week. And falling like it's 1999. Shares of the German software maker SAP plunge more than 20%, wiping out $28 billion in market capitalization. That's following a cut to its revenue forecast and warnings about future lockdowns on business. We bring you the read across for U.S. tech names. All that and so much more coming up. Romaine.
Yeah, and that read across, of course, links back to what's going on with COVID. Of course, we had two back-to-back records here in the United States with regards to new COVID infections. You have lockdowns taking place in Europe, and that's bringing concerns to the forefront about the trajectory of this global economic recovery in the short term. This is what you're looking at, 33.81 technical levels really being tested here on that 20-day and 50-day. Right now, the S&P 500 below those moving averages, still above the 100 and 200. You're seeing a little bit of buying here in 10-year Treasury yields with your yield right now.
Horse.
Taylor,
You're
I'm
emotional.
hoarse. I am so hoarse, so emotional right now, Taylor.
You know.
With this market, 80 basis points. And look at the dollar. It's going to bring me to tears.
Let's pick up right where you
Thank
left
you.
off on 10-year treasuries. Unbelievable. Take a look at this chart, Romaine. You totally knocked it out of the park. Remember, there was the short trade going on where we were looking at price down, yield up. They were starting to show some cracks of that. And certainly today that has unwound as you are now seeing yields fall about 5 basis points. We are below 80 basis points on the 10-year, bringing us right back to that range bound that we have been in for so many months, Caroline. I want to flip up the board because the headlines seem really scary. Red on the screen seems really scary. Earnings, though, the fundamentals doing a lot better than we expected. 18% drop in earnings year over year. That is much better than what we thought, Caroline, which was supposed to be a 30% drop year over year. And the story looks to be improving by 2021. But the markets, at least today, shrugging off this fundamental data.
Yeah, shrugging it off in Europe, shrugging it off here in the United States. Let's get you more analysis. Bring in Ben Emons. He's Managing Director and Global Macro Strategy at Medley Global Advisors. You always put out the right kind of commentary at the right kind of moment, Ben. And I was reading through your one of today. Tell us about the COVID reality. Is the market getting it overblown here in terms of the impact we could see lockdowns have upon certain businesses? Because SAP, it looked ugly.
Hi, Caroline. Great to be back. Yeah, that lockdown narrative is back in the market. And I think it was triggered really by the comments in Europe from both SAP as well as one of the regional governors in Italy suggesting that we should just shut down the entire country. And I think that does hit a snare with markets because, you know, the remembrance of that is in March, then you really shut off economies and activity, then you get this negative reaction in absence of any stimulus at the moment because we still don't have it agreed on it, even though presumably Mnuchin and Pelosi are meeting as we speak right now, maybe to hammer out a deal after all. So the lockdown narrative is back. I think this is a risk-off theme that will stay with us for a little bit into this week. I would agree with Taylor on the earnings front, and particularly if you look at data later this week in GDP data, that will come back to people's mind that the economy actually is very strong and that earnings are strong too. So risk-off maybe temporarily.
When you start to sort of prioritize, Ben, some of the risk that are out there, assuming that we do see this increase in COVID cases, assume that we do see a move to create some sort of lockdowns around the world here, does a stimulus bill actually change that equation anymore if those lockdowns do happen?
It may not be the case in Europe because there the stimulus has been, let's say, approved, but it's not going to hit the economy until much later next year. So that time lag, while you're shutting off the economy, that's a negative for the Eurozone recovery. In the US, however, it probably will be a positive because we already have a strong economy, and the so-called, what I call the arm of the CARES Act, the act that was approved in March that was so large, continues to be going through the economy. If we're adding more stimulus to it, let's say at the end of the year or in the first quarter of next year, then the momentum the economy has not necessarily be derailed that way. So I think if you look at it, it probably is more like a divergence here. You know, interestingly that the euro stayed is strong, But overall, I think this is where it ultimately will play out. The euro would have to start weakening, reflecting this divergence between the US and Europe in terms of economic strength.
Ben, do Treasury bonds remain range-bound as they have been?
They could stay somewhat range-bound because, now let's face it, we cannot really normalize rates like we have in the past. The pandemic, there's too much uncertainty still priced into the Treasury market, and we would have to be really out of the pandemic to truly see normalized rates, like you see, for example, in China. And there's a commitment to keep rates unchanged until we do see inflation. But I think this latest move that we had in rates last week is a reflection, again, of that growth path that we're in. If it does strengthen further, I would expect that eventually we do normalize back to 1%, 1.25%, as this interim phase is just risk off like it is classically works. So treasuries are then bid. I don't think this bid will last.
Risk off as it generally works, we are seeing that bid for US Treasuries. We are seeing yields lower there, but we're not seeing much of a bid for gold, for example. Dollar seems to be the haven of choice instead. Ben, does that signal that actually the market isn't as worried as perhaps it has been in the past, or does it mean that everyone just wants to go long the dollar whenever you're a bit nervous?
It's an interesting play on the gold price, Caroline, because the way I've looked at it is that we peaked in gold in the summer of this year, and we have been on a steady decline. And gold has been this, asset of safe haven, basically reflecting all the uncertainty about the COVID crisis, whether it's political, economic, or financial. So I do feel that the gold price declining signals that the market is looking at this crisis ebbing away over time. And therefore, I think on days like this, even though we're getting a reminder that COVID is by far not over, gold doesn't get that bid. In addition, the real yield in the US stays very negative, and that too leans against the gold price. So I think gold may not, for those reasons, be this real safe haven, unlike what you're seeing in the Treasury market today. I think, again, that's a reflection of liquidity in the market that will seek out opportunities in Treasuries temporarily. And therefore, gold is more of a signal that market still thinks we're heading towards the end of this crisis at some point. Also, considering the vaccine news that's out today was rather positive from Pfizer and Johnson & Johnson.
Ben, always great to get your thoughts. Ben Emons, Managing Director for Global Macro Strategy over at Medley Global Advisors. Now, coming up here on The Big Show, we're going to talk about the plan for China, how a new administration here in the U.S. could affect the trade relationship between the two nations. That's coming up next. Plus, a final farewell. UBS CEO Sergio Armati preparing to step down. He discusses what he's enjoyed the most over the past 9 years on the job. And if you've been looking for those Lysol and Clorox wipes, don't worry. There's a new hand sanitizer in town, Caroline. Easy for you to say. The next product flying off the shelves during the pandemic. We're going to talk about that and a whole lot more. This is Bloomberg. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. We're going to start with Lululemon. The price target there being raised to $415 from $387 at JP Morgan. The analyst citing untapped international presence and outsized growth in the men's segment, which should augment growth in the core North American business. Shares here down fractionally on the day. Next up, Facebook. The price target there being raised to $340 over at KeyBank ahead of third quarter earnings on Thursday. The analyst saying advertising, the second derivative to e-commerce with robust ad spending in the second half of this year. Nevertheless, shares of Facebook down 3%. And finally, take a look at First Solar, as well as its energy peer SunPower, getting a downgrade today to underperform from neutral over at Credit Suisse. The analyst citing valuation following recent gains and expects solar manufacturing will be a cyclical industry with limited tailwinds. Shares of First Solar being peeled back today, down almost 3%. And those are some of your top calls.
Thank you, Romaine. We're also going to look at three other companies, all three falling this morning. It's companies like Boeing, Raytheon, Lockheed Martin. Take a look at this. All really, Caroline, on rising U.S.-China trade tensions. China overnight coming out and saying that they will impose sanctions on Boeing, Raytheon, Lockheed, etc. after the U.S. State Department approved a $1.8 billion arms sale to Taiwan last week. Caroline, this is just one piece of this complicated puzzle that we're continuing to follow.
One piece that continues to always be more intertwined. Let's get a focus on these particular sanctions. CSIS China Power Project Director and Senior Advisor for Asia, Bonnie Glaser, joins us now. Bonnie, your read on this move, was it anticipated, the tit for tat continuing?
Yes, well, this isn't the first time that China has threatened to impose sanctions on U.S. companies selling arms to Taiwan. In fact, it dates to 2015. But it's really only this year that the Chinese have started to name companies. And the most interesting thing about this particular announcement is that China has not said that it will sanction Boeing overall, but just its defense unit. So, of course, Boeing's exposure to the China market is really its commercial aircraft, and it sounds like that won't be affected.
Talk to me, Bonnie, a little bit more about the sort of one China policy that I guess had existed in at least in name for quite some time now, and with the way that the U.S. handled the sale of weaponry and other sensitive goods to places like Taiwan. This idea here is, can we read into this that policy has at least for now been abandoned?
No, I don't think so. The one China policy has always been flexible. It's not really written down anywhere in its very specific provisions. But essentially, the core is that the United States recognizes the PRC, the People's Republic of China, as the main representative of China in the international community. But we've had the Taiwan Relations Act since 1979, and we have a very strong unofficial relationship with Taiwan. And that Taiwan Relations Act mandates that the U.S. provide defensive weapons to Taiwan, and so the U.S. has always sold weapons to Taiwan.
Bonnie, I'm curious, in your study of U.S.-China tensions and security issues, are we at peak mistrust at this moment? Is this what we are seeing play out?
I do think that we are at a new level of mistrust in the U.S.-China relationship. It's just been building over the last 3 years under President Trump, and it went from trade to issues like Taiwan and the South China Sea. And PRC disinformation in the United States. So, yes, it has certainly grown. And it's uncertain whether it would continue. We'll certainly have to see the outcome of our elections. But I do think that there's so many sources of friction in the relationship that regardless of who is president, that we are going to see a very contentious U.S.-China relationship going forward.
That's so interesting, Bonnie, as we, of course, are but a week or so away from the U.S. election. Did the announcement of these sanctions this week mean anything to you in that respect, or was it purely because we had that announcement of the actual deal last week? Is China treading sensitively ahead of the election or not?
I think that this was expected. China has responded in a sort of tit-for-tat way, reciprocating many U.S. actions. When we tried to impose restrictions on certain individuals and their visas in the United States, journalists, the Chinese, did the same. And so I just see this as just demonstrating mostly to the Chinese people that the Communist Party will defend their interests and defend Chinese sovereignty, because that's what the Chinese care most about, their own people and their potential reaction that the Communist Party is not defending the interests of the country.
And so, Bonnie, when we look at sort of the reaction here in markets, I mean, this idea that you have, the Raytheons, the Boeings, the Lockheed Martins, a lot of these companies selling off on this news, investors are a little worried about that relationship. But there's also, I guess, underlying this, the idea here that all of those companies sell things that we know China needs, and they sell things that, to a large extent, China can't get anywhere else. Is there an idea here that these sanctions, as China laid them out today, might pretty much be more symbolic than actually substantive?
Well, that's exactly the word that I would use. I think it is primarily symbolic. I think it is primarily for domestic purposes, though it is laying out a marker and a warning for some companies who might be very exposed to the Chinese market that they shouldn't take actions that would damage Chinese interests. But if you take a company like Lockheed Martin, I think it's only about 1% of their sales, if that go to the Chinese market. Raytheon, a little bit more vulnerable because they had a merger with UTC, which I think is far more exposed to the Chinese market. And with Boeing, once again, it's just the defense unit. I think that China really needs planes from Boeing. I don't think that they can get all of their domestic needs met by Airbus. And even if they did buy less from Boeing today, they'd buy more from Boeing tomorrow. So I see this as, yes, primarily symbolic.
All right, Bonnie, always great to get your thoughts. Of course, that's Bonnie Glaser, Senior Advisor for Asia over at the Center for Strategic and International Studies. Now, coming up here next on the program, we're going to talk about SAP, the big German software company, cutting its revenue forecast for the full year. It also expects a new wave of coronavirus-related lockdowns to hurt demand through the first half of 2021. Is this a problem for SAP, or is it a problem for the rest of the sector as well? We're going to talk about that coming up next. This is Bloomberg.
We have to talk about one of the bigger stories of the day, that is shares of SAP at one point down 22%, looking at their biggest one-day drop ever that we had seen in European trading. The story, of course, they're cutting their revenue forecast for the year, saying lockdowns are hurting demand. That is, of course, affecting their business travel unit. For more on SAP, I want to bring in Bloomberg's Sarah Said. Sarah, besides the revenue forecast, there are also some big questions, of course, about the cloud demand. What stood out to you?
Well, I mean, firstly, it's been a very tumultuous or kind of turbulent 12 months for SAP since Bill McDermott's departure almost a year ago. But, in this set of results, it's a real test for the company who reported that they'll delay, that the pandemic is basically delaying SAP's goals for cloud revenue, overall sales, and operating profit by 1 or 2 years. So investors will have to keep waiting for fatter margins. But SAP has basically blamed, the hard-hit industries such as business travel, which has had an effect on its cloud business, Concur.
How idiosyncratic, therefore, is this, Sarah, do you think? How bespoke to SAP and its own issues is this? Or is there a read across, given the market reaction we saw from Oracle, from Salesforce here in the US?
Yeah, I mean, we've seen some kind of positive numbers from other kind of US businesses, but I mean, SAP is a giant in software provider, and their stock is almost a bellwether stock for European technology and global software as well. If you think about it, they have insight into the Fortune 500 companies, and if SAP tells you that they're a headwind, there's going to be some truth to that. And that there are some customers that are challenged and don't have the money to spend. I mean, there are companies, IT software providers, that opened also with a lower down stock today as a result of SAP's results, like Capgemini, for example.
I'm curious about the legacy, though, here of what Bill McDermott built. And this idea here that you have a company that is effectively more a conglomerate of companies to a certain extent, and how much that plays into this general idea here of them not necessarily being able to transition people over to the new cloud services in a more seamless manner.
So this has been one of SAP's biggest challenges, and something that they have tried to address, or that they have mentioned and talked to investors about, is integrating this giant that they have. As you mentioned, this number of different companies they have, like Ariba and like Concur, and they've struggled with that, and that kind of has shown a little bit. But Christian Klein, the new CEO who became sole chief executive officer in April, has certainly wants to double down on his initiatives with regards to cloud. He wants to double down on investment and their own offerings inside the business, and that is going to have an impact on the company's profitability while it makes that transition.
All right, Sarah Said, giving us the breakdown here. SAP, pretty much the biggest story out of Europe right now, might be the biggest story in the software space around the world. Definitely something to keep an eye on going forward. Taylor, pick it up with the Business Flash headlines.
Let's do it. Let's start with this story. Apple, they want to capitalize on the success of a product that's become an important source of growth. It's planning updates to its earbuds next year. Bloomberg has learned that there will be 2 new models. One is the 3rd generation entry-level AirPod. The other is the 2nd version of the AirPod Pro earbuds. And Bayer has agreed to buy U.S. biotech company Ask Biopharmaceutical. The price, as much as $4 billion. Ask Bio is developing gene therapies for diseases including Parkinson's and congestive heart failure. And Procter & Gamble's new sanitizing spray got perhaps its biggest vote of confidence yet today. Microban 24. It's been approved by the EPA as effective in killing the virus that causes COVID-19. Microban was designed to be P&G's answer to Lysol and Clorox. It was introduced last February. This is unbelievable, right? This is a story that has now become I think a $200 million story, Romaine, as we're all looking at this massive change in consumer habit when it comes to cleaning and sanitizing.
Yeah, I always thought probably one of the biggest failures of the coronavirus response was just the inability to find a lot of these cleaning products and other sort of, personal household products that a lot of folks need. There just really wasn't the ability for some of these companies to ramp up production. And then, of course, we've now learned some companies, Caroline, actually chose not to ramp up production because they didn't think this was going to last as long.
The question is, where can you find it now? Even I can't buy it online. In terms of like when I try and go and get anyone else to do an Instacart, they can't pick it up. On Amazon, I tell you that this new product currently costs $30 to $40 if you want to be purchasing Microban.
Wow.
But a snip. I ain't buying it on Amazon for that amount, but hopefully you can get it in a shop near you. This is Bloomberg.
This is Bloomberg Markets to Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A little after 2:30 here in New York, getting settlement of NYMEX crude futures. Looks like we're setting up here to close below $39 a barrel on WTI crude. This would be the first close below that mark since October 2nd. Obviously, a lot of concerns about the coronavirus, as well as some concerns, too, as well, about supply issues that may be cropping back up in the market. Natural gas prices rebounding back above $3 on the back here of some colder weather moving through. And you take a look at copper there. Copper getting a little bit of a sell-off on concerns here about that economic trajectory. And guys, that economic trajectory, of course, is linked to what we've been seeing with coronavirus and the increase in COVID-19 cases. And I was taking a look at a chart a little bit earlier today that talked about bankruptcies and the number of bankruptcies that we saw during the peak of the coronavirus outbreak. You can see the white line there is the number of bankruptcies, the blue line, the number of coronavirus cases. And when you can see how that pretty much moved lockstep here. This is basically an economic barometer at this point. I'm talking about the blue line, the COVID line. The concern here is bankruptcy started to level off here, and we were getting a lot of people talking about this V-shaped recovery, at least for a certain portion of the economy. The concern is, right now, Caroline, is that blue line starts to tick up in any sort of meaningful manner.
I'm going to pick up your ball and I'm going to run with it, but I'm perhaps going to take it a slightly different direction, because what was interesting to me is, of course, the worry about these lockdowns. We heard it from SAP, how much of an impact that will have on individual companies, how much of an impact that will have on the economy. I bring you this chart, which is University of Oxford's Stringency Index. It basically shows actually only marginal tightening of government restrictions in France and UK and Germany, and indeed, of course, in the US, but that's less surprising. But from the headlines that we're getting out of, say, France, with what was it, something like 52,000 new cases, with talks of bars being closed, with talks of more lockdowns. Actually, this is showing that the lockdowns aren't nearly as bad as they were back in the spring. So perhaps the knock to the economy won't be quite as bad as we think, particularly as countries focus on trying to keep schools open and perhaps doing more targeted approach rather than a wide sweeping lockdown, Taylor.
And Caroline, you wonder if that is sort of what's playing into more heightened volatility at this moment on those fears and those headlines, of course, that we're getting, but lower volatility further out. I want to take a look at spot VIX relative to the November and the December contract. For the first time since June, spot VIX, today's quote volatility and fear gauge, is higher than the November contract. So perhaps some of these election fears are a little bit less than we think, given that today's volatility higher, of course, than November and December further going out. But that volatility curve is something that we will keep in mind, of course, as Election Day just around the corner. And stay with us, because coming up, hopes are fading on a stimulus vote. House Democrats continuing to demand aid to cash-strapped state and local governments. More ahead with Muni Moment. We have Mayor Andrew Ginther of Columbus, Ohio. This is Bloomberg.
All right, the changing of the era is over at UBS. UBS, of course, made that pivot from volatile investment banking to wealth management, and that, of course, can be credited to CEO Sergio Armati, who is stepping down, turning UBS into a world leader that oversees $2.5 trillion in assets. Now, ahead of his departure at the end of the month, he touches on the differences in Wall Street versus European lenders and what changes he anticipates in the U.S. post-election.
Look, as you said, it's very difficult to predict, but what we see and what clients are telling us for Wall. I mean, you're going to see changes. You're going to see asset allocation shifts. You're going to see new policies being implemented. Even if the current administration is confirmed, probably they will need to make changes.
Do you think that could level? You always kept saying to me in quarterly interviews, "Oh, Manus, it's an uneven playing field. I'm comparing the wrong things." So could that be a constructive thing, where maybe the playing field gets a bit more level for Europe versus the US?
We'll see. No, I think that Europe, is it Europe improving or is the US basically losing ground? We'll see. I think that it's difficult to see how Europe can gain grounds from where it is today without, a significant shake-up of its, system, and the U.S. is still not to be underestimated because it's always been able to come out somehow stronger from any changes in administrations or politics. So but of course, maybe at the beginning you may see some dislocations when changes come through.
9 years, long tenancy. What did you enjoy the most in the past 9 years on the job, Sergio?
Well, I would say that I enjoyed most of the days, and the fact that it was always something new. I think that the early days was managing, the aftermath of yet another crisis for UBS, and then and starting to reposition the strategy and working on the execution and getting tractions with employees and clients was the first focus. But then, over time things have changed a lot. I have to say that. I'm not so sure I enjoyed that a lot, but I spent a lot of time in resolving legacy matters, so that was probably less of an interesting part, but still, at the end of the day, a necessary part of my job.
Well, if we look back at the strategy, I mean, you're probably going to be remembered most for downsizing the IB. I look at your trading background in your career. Did that give you additional insight when it came to downsizing the IB?
I think so. Not necessarily the trading background, but the fact that I've been working for many years for a very large investment bank, and also later on I was still involved in doing investment banking businesses before joining UBS, reinforced my belief that you will need to be a one-stop shop in order to be successful in the investment banking world, and in that sense, I knew that UBS had excellent capabilities in equities, in FX, in equity capital markets, in M&A, and strong franchises in Europe and in Asia, and they were good and enough to sustain a business model that would serve well clients and shareholders.
Oh, how we'll miss the Manus Cranny and Sergio Armati interviews, the outgoing UBS CEO there. Now, let's head over to Taylor for this week's Muni Moment.
Thank you, Caroline. And in this week's episode, we're focusing, of course, on the ever failure of Congress to strike a stimulus deal that has all but extinguished prospects of a real bill. 8 days to go now until Election Day, and the Senate scheduled to leave town. Without additional aid, where does this leave state and local governments? Joining me to discuss, Mayor Andrew Ginther of Columbus, Ohio. Mayor, curious what specifics you need in that stimulus bill.
Well, it's absolutely critical that Congress provides states and local governments the resources they need to fight back this pandemic and support critical essential services in our community. We cut our budget this year already by $41 million. You know better than most how critically important income tax revenue is to Ohio local governments. And the critical importance for Ohio's cities to drive Ohio's recovery. You know that 85% of the state's economy comes from Ohio City. So if there's going to be any kind of recovery for Ohio and states across this country, it's going to come through our cities.
Some of the complaints have been the Federal Reserve's Municipal Liquidity Facility program still has about $500 billion in untapped resources. Is that program too cumbersome? The rates not attractive enough for you to borrow?
Well, obviously, we need to do everything we can to make all of these resources more flexible and accessible, particularly to small minority female-owned companies. That's where a big part of our focus has been with accessing PPP, as well as working with CARES dollars that we've gotten additional flexibility on to support those businesses, those smaller companies that have been hardest hit.
Mayor, I'm curious if those companies are telling you what the good and the bad of PPP has been, and if they really need grants and loan forgiveness and not just more debt at low borrowing rates.
Absolutely. 80% of the jobs here in Central Ohio are companies with 50 employees or less. Small business is absolutely critical to Ohio's economy and Columbus's economy in particular. And this is the time we need Congress to step up. You've got Republican and Democratic mayors through the U.S. Conference of Mayors who have been proposing, another round of stimulus directly to states and cities so that we can fight the pandemic and grow our economy. But it's going to require action and leadership from Congress. Speaker Pelosi and Secretary Mnuchin have been working hard. We're calling on Leader McConnell to join them and get this done for our country. Would
something that we can all agree on be better than an all or nothing approach at this point?
I know that resources need to be for cities and states to deal with and continue to fight this pandemic. It doesn't go away at the end of the year. There are going to be additional needs that we have, but we also have to basic city services so that we can continue to grow economies in these countries. So that direct aid to cities and states is absolutely critical to make sure that the benefit of this stimulus.
Mayor, I'm looking at your last tweets, and you talk about the safety in voting, of course, that you are doing, making it safe within a socially distanced place. I'm curious about how you think about voting this election season and, of course, the mail-in ballots. What are you seeing on the ground?
Well, we're seeing incredible turnout here at our early vote center. To vote last week, and thousands of people there. We've seen well over record numbers and a number of folks that are working to vote by mail. Great procedures put in place at our earlier in the state. So we're encouraging people to make a plan. They can a safe and secure way to make sure they're balloted and they are able to protect their health at the same way. Either those absentee ballots, go vote early in person or at their polling locale on November 3rd.
Mayor, what is the issue for Ohio voters? Is it manufacturing? Is it COVID? Is it the economy? What is it?
Yes, yes, and yes. I do believe that COVID is top of mind. The president's mishandling. I think it's also a lot of broken promises that the president has made to people there in Lordstown, in Mansfield, here in Columbus, or in Dayton and Cincinnati. The president has not followed through on his commitments. He's failed miserably at fighting the COVID pandemic, and then you see him being women and seniors just here, but around the country, and they're ready to turn the. They can unify the country and bring our economy back while keeping us safe. And that's why I think Ohio is going to go for Joe Biden.
Well, working on the technology there, and we're getting most of what you said, so really appreciate that. Mayor Andrew Ginther of Columbus, Ohio. Caroline, ever reminded, of course, about election 1 week away.
Yeah, as if we need a reminding. A great interview there, Taylor. Thank you. Now, coming up, well, female medical researchers are publishing less as the pandemic leaves women scaling back their careers. We'll discuss the impact with Dr. Nancy Spector of Drexel University College of Medicine. This is Bloomberg. Time now for Bloomberg Equality, where we examine the bottom line impact of diversity. And our focus this week, well, how the pandemic is widening the gender gap in medical research. Let's bring in Scarlett Fu for more.
Thanks, Caroline. According to McKinsey, a quarter of women are thinking of scaling back their careers or leaving the workforce because of extra demands created by the pandemic. And when you turn the spotlight on medical research, this shows up in a decline in research papers with female authors. So to discuss the ramifications of this, I want to welcome Dr. Nancy Spector. She's a professor at Drexel University College of Medicine. Dr. Spector, set the scene for us, because men historically outnumber women in medical research, so there's long been a gender gap. But how much bigger is that gap now versus before the pandemic?
So thank you for the question. That's an amazing question. So to set context, ideally, our medical workforce should mirror our patient population in the United States, and our leadership should mirror the patient population in the United States. And we are far away from that. In fact, right now, 18% of the deans of medical colleges in the United States are women. The number of women with other diverse backgrounds with intersectionality are even smaller. And we were just making really great strides before the pandemic, and now we are all of a sudden sliding backwards. So already we have seen an effect since March and April of the number of women who are publishing papers. Author papers in particular are decreasing. And why that's so important is not only is it that we need to have researchers working in diverse groups, but we cannot advance in leadership as women unless we publish.
Now, medical research is just like academia in that your prospects are just tied to how prolific an author you really are, especially if you're early on in your career. What is the difference between, say, being the first authorship position or the last authorship position on any given research? Why does that matter?
Oh, that's a great question. So the first authorship is usually the person who's really more junior, leading the charge of the academic thrust of the research. The senior person is somebody who is more advanced in their career, like an associate or full professor, who is well established, who's sort of guiding the way. So ideally, both positions, first and last, are really important for academia, but for younger women, it's first.
Dr. Spector, how are institutions responding to this reality of female academics who have families that they need to take care of and therefore cannot devote as much time to authoring these papers?
So it's a little bit slow. People are starting to pay attention to it. There are a couple things that people are doing. We need to evolve our policies and procedures to support younger women. Some institutions are extending what's called the tenure clock, which means the amount of time we are asked to spend in a certain rank to advance. So extending that. I think what we need to do, though, is expand how we support childcare and other caretaking roles. Women tend to do a lot of the
Yeah, and that's something that's a bigger issue than just in the medical research field. One thing I did notice is there is a lag effect because research papers can take years to produce. So the gap may actually be more pronounced now than we realize, than the numbers show us. What does this mean for the relevance of and utility of research that's currently being conducted on, say, COVID-19?
Well, I worry if we're not representing all of the patients out there. So women and underrepresented in medicine, if we're the patient population, we should be represented by the scientists who are doing the work. The work will be more robust, more forward-thinking, more well-rounded. So I worry about that. In the long term, I do worry about this extended gap in disparities across women, women and men, and underrepresented in medicine, in leadership and advancement of our science.
Do you think there will be some things that will get better? For instance, there will be fewer actual physical conferences that people have to attend, and there will be more virtual conferences that will suit women better?
Well, that's a great question, but I have a women underinvest in social capital to begin with, meaning we don't spend as much time networking to advance our own professional advancement. I worry if we go more and more to online, that gap will also continue to build. So I think, yes, there are advantages to online, but we still need that in-person connection to make relationships and to build social capital to move forward.
Well said. Dr. Nancy Spector, thank you so much for joining us. Dr. Nancy Spector is with Drexel University College of Medicine. She is a professor there. Romaine, I'll send it back to you.
All right, a lot of great questions there from Scarlet Fu. Let's take a look at where we stand in the broader markets here. The good news is S&P 500 off the lows of the day. The bad news is still down 2%. Take a look at your 10-year yield there, where the dollar's going, and the sell-off in emerging markets. We'll talk about it all coming up next. This is Bloomberg.
We're counting you down to the close. There is just 1 hour left in the trading day. I'm Caroline Hyde.
And you're taking a look at the S&P 500 deep in the red. 10 of the 11 sectors now down on the day. I'm Romaine Bostick.
And I'm Taylor Riggs, all about volatility. That bid for Treasury's Caroline markets gearing up for the election.
They certainly are. Volatility's where it at. If a picture paints 1,000 words, the words are sell. Sell, particularly Royal Caribbean, for example. Cruise line is on the lower side, but remain every single industry group in the red as we see it.
Yeah, pretty much nothing spared here. I mean, you only really have about 10 stocks in the S&P 500 that are even positive on the day. Not only is it the cruise lines, but you got the big FANG names, the metals companies, pretty much everything across the board now being sold off.
So look, you guys, just an hour left here in trading, one of the most important hours. Here is, of course, what we are watching as we head towards the close. All of my eyes are on VIX. We're up 5 points to almost a 33 handle on the VIX. We haven't seen these types of moves really now since September 3rd. So the VIX, the highest, as we know now, since September 3rd. What moves to the upside all moves to the downside. Romaine, that is what we're seeing in the equity markets today.
Yeah, and I mean, of course, when we talk about what's going on with that volatility, you have to take a look at what's been happening with the technicals, too, because a lot of folks are keeping an eye on that 20-day moving average, that 50-day moving average on the S&P 500. It had been a line of support for quite some time. And you take a look at that yellow line, that's your 50-day moving average. That had not only been a line of support, but you see it had been trending higher, which was always a good sign. That's sort of flattened out the last few days. And right now we are trading below that 20-day and the 50-day, still a far ways off from that 100-day and 200-day moving average. So not necessarily panicking, but you get a sense here right now, Taylor and Caroline, that the market is a little bit on pause until they get some clarity on what's going on with COVID and, of course, fiscal stimulus.
And clarity as well. For once, maybe we got a bit of it coming from the White House, but it seemed to be a gloomy picture. Take a listen.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can. And if you look at full context of what I was talking about is we need to make sure that we have therapeutics and vaccines. We need to make sure that when people get sick that they have the kind of therapies that the President of the United States has.
We're going to defeat the virus. We're not going to control it. Today, for me, it's the lack of control on the virus that really dictates trade. We're looking, what the numbers, 85,000 being added every single day in terms of cases in the United States. We're seeing records being set in France, records over in Germany. This is why we're seeing shivers down investors' spines at the moment, Romaine.
Yeah, absolutely. And I remember like several months ago, we joked about this idea how everyone in the market had become sort of an armchair epidemiologist. But if there's any reminder as just how much the COVID crisis matters to investors and matters to their investment decisions, I think what transpired over the weekend, not only here in the U.S., but really worldwide, was definitely a reminder of that.
And Romaine, the lack of stimulus. Where did that whole reflation trade go? It is unwind today, down 4 basis points on the 10-year.
All right, let's bring into this conversation Olivia Engel. She's CIO of Active Quantitative Equity and Senior Managing Director over at State Street Global Advisors, joining us today from Boston. Olivia, let's start off here with the economic picture, the economic backdrop, an economic backdrop that is in recovery, but again, it is without fiscal stimulus right now, at least here in the U.S., and for the moment, it appears to be a backdrop that is going to have to grapple with a rise in COVID-19 infections. What do you make of it?
Yeah, absolutely. This is a significant concern. And a lot of the confidence I think the market has been working on over the recent months has been a confidence that a vaccine will be developed and will be rolled out and everything will be rosy thereafter. But even if the consensus is a fair estimate that in 2021 a vaccine would be found, there are still a number of vulnerabilities in the equity market and in companies that are listed on the equity market that they just don't survive that time. So the time is of the essence, and how the consumer can be protected through that time period, how balance sheets on companies that are in a precarious situation can actually remain solvent through this period, I think will be a key determinant of how deep the economic impact can be and its long-lasting impact.
It was interesting how much Europe almost helped guide the US lower today, particularly what was happening in Germany. The fact that SAP, a key software bellwether, was saying that these lockdowns are really hurting its business, Olivia, and notably also the IFO data, the business climate index coming from Germany, also looking pretty woeful, dropping for the first time in 6 months. Where is your gauge in sentiment at the moment? Because it's been notable that throughout the pandemic, the investor base has been able to shake off the immediate urgency, the immediacy concerns to buy into stocks for the hope that things will get better. Where is immediate sentiment for you?
Yeah, that's right. And we have been concerned about the singular theme that investors have really latched onto in driving some of the most expensive parts of the market that have become increasingly concentrated to concentration levels that we really haven't seen since the dot-com bubble. And so the singular theme of the FANG stocks and the big mega caps outperforming strongly and leaving everything in their wake has created its own risk. So in sentiment, we've actually started to see some signs that investors may be shifting away from this theme in looking at a multidimensional picture of investor sentiment, not just by looking at how the prices have moved, but looking broader to how earnings are being revised, looking at linkages through the supply chain, looking at how hedge funds are positioned and starting to rethink some of the positioning in their portfolios. So we have seen some signs that this singular mega cap theme is maybe starting to get some attention diverted away from it.
What does that then mean for this momentum trades that we see? Big momentum to the upside, and then days like today, big momentum to the downside, as we're reminded.
Well, momentum as a phenomenon is something that you really need to be mindful of. It really has a carry trade distribution associated with its payoff, which means some people can coin the phrase, it's like picking up pennies in front of a steamroller. It feels really easy to capture the value added in incremental ways day after day. That's what momentum looks like. But when it fails in a very big way. And that's another way of saying there's a big negative skew associated with the payoff. So we have to be very careful of the embedded sentiment or momentum exposure that we have in our investment portfolios and seek to balance that with other things that can generate more of a positively skewed payoff, like quality characteristics and reasonable valuation in stocks.
There seems to be a little bit of a shift there, though, Olivia, where folks are either moving there or at least trying to identify those types of names here. How much of a rotation do you see going on already, and do you think it's going to be sustainable?
Yeah, I do think there are some early signs that we've seen in positive sentiment starting to emerge in a number of companies in the auto sector, in consumer discretionaries beyond the mega caps, in some of the consumer durables, in retailing, in consumer services, capital goods. So some of the more cyclical, out of favor segments, we've actually seen some renewed interest in terms of these multidimensional ways that we measure sentiment. So we think that's a really good sign for investors in being able to generate a more diversified source of returns rather than something that's just dominated by one highly correlated theme.
We always love having your voice on the show, Olivia Engel. Thank you so much. CIO of Active Quantitative Equity at State Street Global Advisors. Great thoughts on how sentiment is shaping up and the rotation trade. Coming up, signs of optimism. Well, AstraZeneca resumes trials after some previous safety concerns, saying its vaccine candidate produced an immune response in older adults. What this means in the race for a vaccine. Plus, the impossible investigator. We speak to the CFO of Impossible Foods about its new initiative to eliminate animal agriculture and the impact of the pandemic. And not playing around, why the CEO of Mattel thinks that innovation and creativity will help them overcome the pandemic and have a happy holiday season. All that and so much more coming up. This is Bloomberg. Lee Kun-hee, now the driving force behind Samsung's rise, has died at the age of 78. Bloomberg's Manus Cranney took a look at his legacy and the path ahead for one of the world's most powerful electronics players.
Lee Kun-hee was the visionary behind Samsung Electronics. The transformation from a cheap appliances maker to the world's biggest producer of smartphones, televisions, and memory chips. He began relentlessly pushing the company up the technological ladder after taking to the helm in 1987, following the death of his father. Famously telling employees to change everything except your wife and your children during his drive to challenge rivals such as Sony. By the early 90s, Samsung had surpassed its Japanese and American peers to become the industry leader in memory chips, then began dominating flat panel display and high-end mobile markets soon after. The global electronics powerhouse today is South Korea's corporate crown jewel and a cornerstone of the economy. But the rise to the top had its setbacks and controversies. Lee was mired in political scandal in the late 1990s after being convicted of paying bribes to the government in 1996, for which he was pardoned a year later. In 2009, he was found guilty of tax evasion and breach of duty for intentionally causing losses at a Samsung subsidiary. Nevertheless, the reins are now set to pass to his only son, J.Y. Lee, who's been the conglomerate's de facto leader since 2014. The younger Lee is grappling with two simultaneous legal disputes with South Korean prosecutors over allegations of bribery and corruption, which he's repeatedly denied. Still, J.Y. Lee is expected to eventually inherit the $300 billion company that continues to be one of the world's leading electronic players.
All right, our very own Manus Cranney with that report. Now, let's get a quick check of the latest business flash headlines with Taylor.
Thank you, Romaine. We're going to start with PetSmart, kicking off a junk bond offering of almost $2.4 billion. It's part of a larger financing package that will separate the company from its online counterpart, Chewy. A group led by private equity firm BC Partners is betting the companies will be better off on their own. 3 years ago, the group loaded up PetSmart with debt to acquire Chewy. Uber is being sued over the way it uses customer ratings. According to a suit filed in San Francisco federal court, the ride-hailing service violates the U.S. Civil Rights Act by firing minority drivers based on how they're rated by customers. Uber insists its drivers are independent contractors who are not covered by workplace protections of the civil rights legislation. And the parent of coffee and donuts chain Dunkin' is in talks to be acquired by private equity-backed Inspire Brands. According to the New York Times, the deal is valued at $8.8 billion, could be announced as soon as today. Shares of Dunkin' Brands have more than doubled since March. Inspire Brands owns Buffalo Wild Wings and Jimmy John's. Romaine, it's all about that mobile app ordering of your coffee on your way to go.
All right, Dunkin', my third favorite donut out there. All right, let's get over now for Options Insight with Abigail Doolittle, where Abigail, you're looking at the sell-off today.
And I'm curious to know what your first and second favorite donuts are, Romaine. Yes, we are going to take a look at today's stock sell-off, and to do just that, Scott Bauer of Prosper Trading Academy, the CEO over there. Happy Monday to you, Scott. Not so happy for stock investors, or at least those who are long. We're looking at the worst day for stocks since the beginning of September. A variety of factors here, the virus. We also, of course, have no stimulus. China slapping sanctions on some of the defense contractors here in the U.S. What really stands out to you, and do you think it's going to last?
Yeah, there's certainly no lack of news here. The one you didn't mention was the possible extension of a decision on the election. A few months ago, and even as recently as a few weeks ago, we saw a big divergence in the VIX, Abigail, because a lot of people thought that this was going to go on. We weren't going to get a decision. It was not going to drag on. But then we saw the VIX futures really come back into line, and we're still seeing that. So, I'm hearing a lot about that maybe is the part of the big sell-off today. I don't see that. I do think it's really the news coming out of Europe, out of SAP, that maybe this is a precursor for some of the big companies here.
Yes, that's sort of definitely an interesting potential tell on the tech IT spend, unless perhaps SAP is using the cover of this macro, let's hope not, to take the opportunity to guide down. But you were just mentioning the VIX, Scott, and if we go into the Bloomberg terminal, the VIX has really been in a range, and it's clear that this range is either going to break to the upside, back toward the highs of the year, or we could be going right back down toward below 20 toward 15 or so, which would represent, a move that would be positive for stocks. Which way do you think that it's going to go? It seems as though this break is probably going to come pretty fast, pretty soon.
If you can give me about 6 weeks' time, it'll be to the downside. Would be my prognostication that the VIX will start normalizing lower as the market gets settled in a little bit.
Super quick, Scott, before we go to your trade, do you think that you could see a spike higher, very fast spike up to 50 and then back down, or do you think that just down?
I don't see a spike that high. I really don't, Abigail.
Okay, so that's the answer.
Yep.
Yeah, no, that would be the answer around the range, because it really looks like it's going to make a big move one way or the other in probably a week or two. Talking about your trade, though, you are relatively bullish here on Overstock.com into earnings.
I am, and I'm going out to next week's option, November 6th, so we have about 2 weeks here. I'm buying the 80-85 call spread to the upside. I can do that for about $1, $1.10 or so. Right now, the option market to next week is pricing in a move of about $15. If we get that to the upside, that takes us to that level, which is also some pretty decent resistance in the stock. So I really like the reward to risk on that trade.
Well, it's certainly going to be interesting to see what comes with that earnings report. And then later this week, of course, on Thursday, I think it is, Apple, Amazon, Alphabet, Facebook, Twitter. It's going to be an earnings bonanza. We'll be here and looking forward to the next time that you join us for Options Insight. Scott Bauer, CEO of Prosper Trading Academy. Thank you from New York. This is Bloomberg.
The race for a vaccine for COVID-19 continues. Take a look at this chart. Really, it's been the therapies, and some of these vaccine makers have been the big outperformers. Moderna, Regeneron, they're up 250 and 55% year to date. Other vaccine makers like AstraZeneca, they're still up about 9% year to date. News today, of course, that vaccine is producing an immune response in older adults. I now want to bring in Drew Armstrong, who leads up Bloomberg's healthcare coverage for us. Drew, your take on this AstraZeneca news?
Yeah, listen, this is good news. It's not the kind of final answer that you need on any of these vaccine studies. But when we think about who is at most risk of this disease and most needs protection, and also the reason that a lot of us are taking, measures like wearing masks and social distancing, the folks that need protection are this group of older and elderly people. And so you have, seeing these kind of surrogate markers of immunity is very, very good news. That said, it's not the out in the real world trial of tens of thousands of people that we're going to see if this thing really does work when it comes to actually stopping infections from the virus.
And so where do we stand, though, with regards to some of the other competing vaccines and treatments out there right now, Drew?
Well, the front runner in when we think we're going to see results is probably still Pfizer. Moderna Inc., who you all just mentioned, is obviously in the race too. And AstraZeneca, despite being having their trial halted for a safety concern and then restarted in the U.S., I believe just recently, those are kind of the three that we're looking at. But I think we've moved from a, end of October timeline until sometime in November, in part because the U.S. FDA has said that they want to see 2 months worth of safety data. And I think that's really, given companies a moment to pause and say, all right, listen, this is probably going to slow things down a little bit. So we're probably at least several weeks out from getting a real answer on both the efficacy and safety of the earliest of these vaccines.
Drew, of course, the numbers, the infection rates are alarming. 85,000 cases a day here in the US. But then you drill down and look, 800 deaths a day is 800 too many, of course. But can you link to us about what the rates are looking like at the moment? Because when I look at France's hospital use jumping the most in almost 7 months, that worries me. Should we be worried?
Yeah, I think that there's when we try to do these comparisons to earlier in the spring versus now, there's a couple of really important things that you need to keep in mind. One, we are testing a ton more now. So we are finding more cases. There's not exactly an apples to apples comparison of cases in the spring versus cases now. What you can and really should be watching are hospitalizations and deaths. And even that's not perfect because we have gotten better at treating this disease. When this disease hit New York, for example, we did not have a great idea what we were doing. The hospitals there were very, very quickly inundated with patients, which hurts care as well. And in addition to that, we were in a situation where we weren't exactly sure if everyone was going to be able to get the care they needed just because of a resource level. Now we have a better idea of how to treat patients. We have some better therapies that are available. And so you're going to see the rates of death go down from this. That said, we're at a point in this epidemic right now, in the United States at least, where the whole country is getting hit at once. In the early part of the spring, really it was just kind of a couple of major travel centers and then scatterings of cases around the country. Now we have a real bed of infection to infect other people just about everywhere, and that is not good news. Even if the rates are coming down, this is a disease where denominators matter, and the denominator has gotten much, 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 much bigger than it was earlier this year.
Drew, you always put it into such great perspective. We thank you for the context. Drew Armstrong there for us. Now, let's put it into the context of the markets right now, because coronavirus is what's hitting us. Certainly, Taylor, we're seeing a reaction off by 2% on the Nasdaq.
And this is a different reaction than we saw last week when you had mini sell-offs and then the 10-year didn't budge. This time, bonds catching a bid. You're down 4 or 5 basis points alone on the 10-year and the 30-year. This is Bloomberg.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick. A little less than half an hour to go here in the trading day today.
Let's check out every single industry has been in the red. There's a little chink of green and it's utilities, but look, barely up 0.1%. Energy is your worst performer. Industrials, materials. It is the woeful COVID cases that we look to, whether it's 85,000 more that we're adding in the US, whether it's record numbers in Europe. That's really set the sentiment for today, Romaine.
Yeah, and setting the sentiment, you flip up the board here, you take a look at the Nasdaq 100, because it was backsliding as well. Remember, we're down about 5% or so over the past 10 sessions, basically going back to that October 12th date where the market seemed to have peaked in this latest round of the cycle. However, as we're speaking now, we are seeing a lot of those large cap tech names start to actually try to flirt with the green territory. Apple right now only down 0.1% after being down about 1%. Amazon, pretty much a similar situation, as well as Netflix and Tesla. So something to keep an eye on as we count you down to the close to see if we can get a rebound in some of those heavyweight names enough to actually pull up the rest of the indices here. Caroline and Taylor, you could take a look at where the Russell 2000 is right now. Remember, we had that rotation into cyclicals last week. That's being sort of rotated back into the barn today. A pretty big underperformance there for some of the small cap names.
Great deep dive across the sectors. Let's bring you some bespoke corporate news for you right now, though, because as supply chains for traditional meat buckled amid the COVID crisis, consumers filled their carts with plant-based alternatives. Instead, Impossible Foods, Beyond Meat, you know the names, but with growth coming, so too comes responsibility. Impossible Foods is doubling the size of its R&D team over the next year, seeking the world's best scientists to help eliminate animal agriculture and its detrimental impact on the climate, they say. Joining us, we're very pleased to welcome back CFO Dvaid Lee, of course, in San Mateo, California. David, it's always great to have you here with us. What do you want to achieve? Doubling the size of the R&D team, that means adding about 150, but I'm really taken by the 10 additional scientists you call Impossible Investigator Program. What will they do?
Well, our scientists aren't like scientists you might meet at a typical food company. Impossible Investigators really have the option to pursue anything in science. These are folks who have distinguished careers as tenured professors who can instead use all their gifts to create technology, research, and development that shows up in the hands of meat eaters and helps change the world for the better. walking in the path that Pat Brown, our founder and CEO, started back in 2011. It's the key to our success. It's why the Impossible Burger is so tasty, and it's critical for the mission we have.
David, making another expansion as well into the Canadian retail food chain. I am curious where you are in terms of expansion into the retail versus the grocery store and the restaurants versus the grocery store. Where are you on that mix?
Well, I can share that we certainly have adjusted in this current crazy environment in the global pandemic. We've met the meat eater where they're wanting to buy meat, whether that's in the grocery store or direct to consumer. You know, our grocery business has grown 100x since January, from a little under 150 grocery locations to now 15,000 globally. And just this week, just today, actually, we announced 600 great grocery locations in Canada, along with 200 in Singapore and Hong Kong. And it's because that's where the meat eater goes. And 90% of the customers of Impossible Foods are self-avowed meat eaters. So our business has grown with where the meat eater likes to shop, and we'll continue to adjust to meet their demand.
And so when we talk about this R&D spending and this idea of trying to sort of come up with new and creative ways to sort of feed the appetite out there for meat alternatives, David, there's a cost associated with that. And I remember early on in the process, when Impossible Foods sort of jumped on the radar of a lot of folks, there was a lot of talk about the cost just to produce those original burgers that you guys were doing. How much of that factors in right now to, I guess, a long-term strategy for the company in dealing with those costs and making sure that what you put out at the end of the day is not only affordable to people like me, but also profitable to the company?
Well, it's very important that we not just deliver a great tasting burger or a great tasting piece of meat made from plants to meat eaters. It's got to be affordable. It's why we took a 15% price reduction in February, because frankly, we could. And it's the source of that advantage we have is we use 96% less land, a fraction of the water. We don't have to ship, grow, slaughter, process animals in, frankly, working conditions that in this global pandemic we see are quite challenging for the incumbent industry. We believe that we will pass on to both investors as well as our customers our continued reduction in price and cost, because we can, and because our technology was designed from the very beginning to be affordable.
David, you're a man who's worked at several international businesses, experience over at Zynga, Del Monte. You know what it is to take a brand international, and you have been doing with Impossible Foods, going into Canada, you're in Singapore and Hong Kong. How are you seeing the international demand spread? How are you seeing supply chains evolve for you and demand evolve?
Well, what's interesting about the category that we are in, which is meat, 40%, for example, of global meat consumption is in Asia, with a large portion in China. And the thing about meat eaters is they can take the very same piece of meat, and in their hands, they can make it bespoke or custom to the cuisine and culture, to the meal that they are seeking. And as a result, ours is a global rising tide for better meat that meat eaters can enjoy, but is better for their health and is better for the environment. We designed in our supply chain the ability to partner with large global food manufacturers like OSI, which we announced a big deal with, so that we could scale faster. And we didn't have to vertically integrate and build every single plant required to meet this global demand. And I think you'll see us continue to partner as we expand globally.
David, follow up to me on something you just said, where you said we have the ability to cut prices. So are you profitable and willing to be less profitable in order to get market share, or are you willing to sacrifice some profitability at this moment?
Well, our focus continues to be on our mid to long-term mission. Now, we have to stand tall and deliver for all the investors that have gratefully, we received $1.5 billion to date from sophisticated investors, Temasek, Viking Global, Coatue. They expect us to deliver against their deal models, and we will. But the good news for Impossible Foods is we can provide a great return to investors as we steadily reduce price, because scale is the only thing we need to have increasingly better cost structure. It's going to take time. We are a tiny fraction of the meat industry, But as we grow, we'll be able to create financial return and more affordability. We'll be able to do both.
All right, David, always great to have you on here. That's the CFO of Impossible Foods, David Lee. All right, stick with us, of course. We are counting you down to the close. We'll be back in a moment after this break. This is Bloomberg.
That means we have 60 minutes and almost 40 seconds to the closing bell. Here's a look at your markets because it has been a down day across the boards. Every industry group falling. The Nasdaq off by 1.8%. Big tech has been hit harder than from what we saw in Germany. SAP, the software maker, really spiraling the most down since the year 1999, as it says. COVID is impacting its bottom line. We're also seeing a worldwide sell-off. Europe hit hard, all country world index in the red. And crude, certain commodities on the downside. Oil, of course, really gets flung around by COVID cases, by the concerns about the economy, and not much bid for gold, Romaine.
Yeah, I mean, whether you're a short-term trader or active trader here or a longer-term horizon type of money manager, the trajectory of this coronavirus pandemic is really shaping a lot of investment decisions right now. We should also point, this is, of course, a big week for earnings, the busiest week on the S&P 500 calendar. Taylor, we're going to get about 180-plus companies reporting this week that I guess, potentially give us some insight not only to what they did in Q3, but more importantly, how they see their future business going forward for the next couple of quarters.
And typically we love earnings season because you really get an insight into what these companies are saying. The problem is this time around, if you take a look at this chart, we're all trading on these macro headlines. The 1 month implied correlation has been rising, showing that we're not seeing some of these idiosyncratic moves. We are all moving on these macro headlines. But like you said, on the flip side of that, getting a lot of earnings Tuesday, Thursday, of course, the big day. Interestingly enough, we're doing some statistics. Typically, if after you miss on the bottom line, you fall about 2.3%. Stocks this time around are falling about 4.5%, Romaine. So you are really seeing some big moves to the downside. Even if you've historically beat on the upside, your shares are still falling on average. That can explain why we've seen some of these big moves to the downside this earnings season.
Yeah, and we're keeping an eye on Twilio. That's going to report tonight. Of course, a lot of the earnings that we really care about coming on Tuesday night as well as on Thursday night. Right now, you take a look at where we stand in the broader markets here. S&P 500, you got about 475 stocks to the downside here. Only about 29 are higher. You take on about Royal Caribbean down 10%, Hasbro down 9%. A lot of the airline names, and I guess a lot of these folks, these names, Caroline, that were part of that recovery trade, if you will, getting sold off today. It'll be interesting to see how folks feel when they come in tomorrow.
Well, that's all the all-important case, whether we get numb to some of the COVID cases in terms of the numbers that we see across in Europe and the US, but where we do see continued haven bid, it has been into US treasuries, have been into the US dollar, and of course emerging markets fall out of favor. We might see a little bit of profit taking after that run up that we saw in October. This is Bloomberg. This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
Let's check out what has been happening to your majors today. It has been down, down, down. We bounce off our lows at around 1:30, 2 p.m. Nevertheless, we remain off by about 2 percentage points across the board, moving in lockstep in terms of the benchmarks. Tech gets sold off less. In the eye of the storm is the industrials, the materials, and indeed, to a certain extent, your small caps remain in the blue.
Yeah, and you're seeing some selling pressure come in here in the final 10 minutes of trading. You flip up the board, you can see that selling pressure had already materialized in the Dow Transports. A lot of those airline names really taking it hard on the day. Also, managed care sector. This has been really whipped around a lot lately. These are mainly the hospital stocks you're talking about here, these managed care companies. A lot of concern here, I guess, about the direction of healthcare policy here in the U.S. based on the outcome of next week's election, or the deadline for voting here in the U.S. on November 3rd. Home builders, which of course have been the one bright spot in this market now for several months, selling off pretty hard. You got some new home sales data that showed what possibly is probably just a speed bump in the trajectory here, but with rates rising last week, some concerns here that rally could peter out. And of course, the aerospace index, a lot of your defense names in here, like Raytheon, Lockheed, Boeing, all lower on the day, of course, on the news of those China sanctions.
Yeah, we had to keep reminding ourselves that there's more at play than just the COVID crisis. There are plenty of geopolitics to digest. Let's do it all now with Brian Nick, Chief Investment Strategist at Nuveen. Nuveen, of course, has assets under management of a cool $1.1 trillion as of September the 30th. It's great to have you with us. And talk to us, Brian, about what you're seeing, these bouts of volatility, these worries about the COVID crisis. They're nothing new. Why then today? How do you trade this?
Yeah, first, thanks for having me. Yeah, today looks like a pure risk-off day due mainly to COVID. If you look at the currencies that are outperforming the U.S. dollar on what's otherwise a very good day for the dollar, they tend to be the currencies located in Asia, which tells you, I think, something about the relative preference here that investors have, wanting to hold currencies where COVID-19, frankly, is not on the rise to the same extent that it is in North America and in Europe. I think the other thing that's different this time around compared to, say, the summer spike that we got is there's no fiscal stimulus to be had here in the U.S. So over the summer, we knew that spike was going to mean fewer customers going out, shopping in stores, going out to eat, taking trips. But we had the sense that small businesses and those consumers who had lost their jobs were being supported by the federal government. Those programs have all but expired, and there's not really a promise for any replacement until perhaps the middle of the first quarter of next year. And so what we're seeing, I think, is at least a pause by markets as they kind of evaluate what this is going to mean for earnings and for the economy as a whole in the fourth quarter.
Brian, a question that was posed to me that I'm going to pose to you is there any sort of, I guess, potential here for a Fed surprise when they meet following the next week's election?
Yeah, it's a good question. They actually moved their meeting to Thursday, and I think to give themselves some room after the election. And I doubt very much they want to deliver any surprises to markets during what could be an ongoing counting or recounting of some of the votes and possibly enough states to make a difference. So I don't think that's their plan. But I think what you'll probably see from the Fed is, using their megaphone, using that press conference to, pound the table yet again for more fiscal stimulus. I honestly do think the Fed probably thinks there's not much they can do from a monetary perspective to help the economy at this point, aside from what they've already done, very low interest rate pledges, changing their inflation targeting scheme. But what's needed now is just basically direct aid to the affected parts of the economy, and of course a vaccine, which would be the ultimate stimulus package. But we're probably not going to get that until sometime in the middle of next year.
All right, we're speaking here with Brian Nick, Chief Investment Strategist over at Nuveen. Going to continue that conversation with him. He's helping us count down to the close. But Taylor, taking a look at some of the other markets that are moving right now, we had been talking a lot last week, of course, about the reflation trade and about that recovery trade. Is it still intact?
Yeah, take a look at this chart because it's always been growth versus value. Growth has been the big outperformer year to date. Recently, though, in the last week or two, a lot of that has unwound as you've seen value really start to pick up a little bit. Today, though, then, of course, as you can see there, the story all falls apart. Interestingly enough, it's days like today where big tech is now the defensive sector, really providing a lot of that defense, even though they've been some of these high-flying stocks. I want to speak about some high-flying stocks here. Let's take a look at my stock of the hour. Shares of Twilio. RBC maintained by $370 price target. This is a stock. They're up 200% year to date. We're going to get their earnings in about 10 minutes. Our analysts are saying that the expansion rate is not priced in to consensus. They're looking at 30% growth for the next 4 years. Many of their customers as well are in the initial phases of deployment. This is when the company is building the foundation to boost usage in the future. So Twilio is the stock that I'm looking at. Of course, one of the high-flying names that is falling today, but we will get an update from that company after the bell. I do want to finally just flip up the board here, and Brian, let me bring you in on this conversation. We're taking a look at a 60-40 portfolio. Today we're getting crushed. You're down to the lows that we haven't seen since mid-September. And I am curious, as you take a look at the 40 portion of that, the bond portion, is that behaving the way it is? Is a 10-year at 80 basis points giving you the correct correlation on moments like these?
It is giving you the correct correlation. It's not giving you beta, though. So not just whether they move in different directions, it's how much the 10-year is going to move in your favor on a day when the Dow is down 2 or 3%. And that's really, I think, where we're losing here with interest rates this compressed, this close to zero. That beta that you're trying to capture in a portfolio to try to muffle the overall volatility is not going to be there. So doing other things with that bond portfolio makes more sense. Even if you lose some of that negative correlation, what you're really focused on over time is total return. Yes, you want to mitigate some risk, but you also want to generate as much total return as you can out of the 60-40 portfolio. We know that one thing that U.S. Treasuries are not giving you right now are high rates of return.
And so where to put the money? Are you looking at high-yielding stocks? Are you looking at the U.S. dollar as the appropriate sort of hedge?
Certainly, if you need income in a portfolio, you can look at more kind of higher dividend-paying stocks to offset some perhaps a smaller overall fixed income allocation. We're also looking at parts of the bond market. We still like emerging market debt, especially dollar-denominated debt. It's tend to perform pretty well when you have interest rates that are low and an overall economy that's moving at least in generally in the right direction, albeit not today. And then you can look at things that diversify away from both of those things, like real estate. Getting that into a portfolio, generating income, low correlation rates. Not going to deliver that negative correlation that bonds often have in the past, but at least giving you something closer to a zero or a very low correlation can help offset some of the risks that you're probably not taking by being in bonds.
That diversification into real estate, though, Brian, I mean, that was a trade a lot of people were talking about pre-COVID. Since COVID, of course, there's been a lot of pressure on real estate, at least in certain markets. I'm curious as to how you play that trade right now, given some of the uncertainties regarding commercial and residential real estate.
Sure, there's obviously a lot going on in the economy. And I think just the longer-term shifts that we were seeing away from brick-and-mortar retail into more online shopping. I mean, that has implications for how we're investing in real estate, like industrial real estate. Actually, one of our favorite trades right now, because industrial real estate is so closely linked to things like the growth of e-commerce. The more people are shopping online, the more warehouses you need, the more shipping facilities you need to fulfill all those orders and to make sure people get those packages on time. We often think of industrial real estate as being maybe like factories or ports, but a bigger and growing part of it is just basically servicing that growing online sales percentage, which is beyond our wildest expectations here in 2020 already.
Brian, I am curious. Overnight, early this morning, SAP was a software stock, of course, that fell 22%, and it started to bring down parts of the market with it, other software stocks. Is that a sign or a problem to you, of course, that when you get a big name that gives a little hint of something not going right, everything else starts to roll over? Is that the risk at this moment with stocks and valuations where they are?
I think it certainly is. You don't even need a big kind of macro driver. It can be enough that there's just a little bit of negative sentiment in the water, and especially stocks that have done very well, or a sector like technology that's outperformed by so much this year can certainly have that sort of downdraft. We saw that happen in September. I mean, the stocks came roaring back for the most part, and now we may be in a situation again. I think that reflation trade you mentioned earlier, which was good for industrials, good for banks, was actually going to be not so good for technology companies. But the more we're living in this COVID economy, if there's not better news on a vaccine, if there's rising caseloads, hospitalizations, fatalities, I think those technology stocks are going to find support because those are the companies that people are going to look to deliver revenue regardless of whether we're kind of locked in our homes or traveling about more freely and normally.
Brian, therefore, to the news out of Germany, SAP, bellwether of a software maker over there, the fact that they fell 20%, worst day since 1999, because their numbers highlighted that actually not all software makers are making the best of it in COVID. In fact, big clients are putting off certain purchases, and that spilled into the effects we saw with Oracle and the likes of course, Salesforce falling on the day. Are you worried that perhaps we are going to start to see companies postponing investments, even in the heralded areas such as big tech?
Yeah, one of the most interesting parts of the GDP number we're going to get this week is going to be the investments category. I mean, it's a backward-looking number, but I'll be interested to see one of the stronger things that really held up well was software-related investment in the second quarter relative to at least everything else that was really struggling. So I'm going to be interested to see how much software-related investment companies continue to do in the third quarter based on those GDP numbers, and then what we're getting from the earnings data perhaps is more indications on whether companies are going to continue to invest moving forward. Really, I think a fork in the road here for a lot of companies, whether we're going to go more towards an online sort of working from home model, or whether there's a view to by this time next year we'll have people back in offices, so maybe that level of investment is not necessarily forthcoming. But I think that is certainly a risk. We got this big sort of initial jump in software investment, and moving forward, there may not be as much of a need to do that.
All right, we're speaking here with Brian Nick, Chief Investment Strategist at Nuveen. We had the closing bells just a few moments ago. You can see there on your screen where we stand right now. S&P 500 closing pretty much at its lowest level that we've seen since October 6th. But more importantly, this is the worst day that it's had now since September 23rd. And we should point out, it really hasn't had any sort of meaningful move higher now for about 2 weeks. You wonder, Caroline, if this is folks either abandoning, turning their back on equities, or maybe just sort of moving into a holding pattern as they await the outcome outcome of the U.S. election.
Are we treading water? Are we just awaiting that all-important vote, of course? And but what's also notable, Taylor, is the fact that we did actually get pretty big commitments in terms of volume today. We saw the S&P 500 average volume up 22%. We saw it up about 22% for the Dow Jones Industrial Average. So people were committed to this selling to a certain degree.
Well, and we're also committed to investment-grade bonds. LQD, the investment-grade ETF, in the green. You're up 0.2%. So you're buying treasuries, you're buying investment-grade. You are not buying high yield, as high yield falls about 0.9%. And Brian, that's where I want to go to you next. Are we sick of 80 basis points and getting zero after inflation? You're losing money in treasuries. So you're going to investment-grade, and you feel safe because you know that the Fed will bail you out.
I think it's a combination of that. The Fed certainly has supported that market, although the actual dollar amount of the purchases isn't, I don't think, what's supporting it. It's just a sense that keeping interest rates low, as long as things are generally moving in the right direction economically, yeah, you can get a kind of an off quarter here or there. You tend to see those investment grade spreads grind lower. So it's almost like kind of a carry trade. Like, would you rather own, investment grade or would you rather own treasuries? I think the choice is pretty clear, although the spreads aren't nearly as attractive as they once were. And frankly, as we're managing these assets in portfolios, we're not actually on the riskier ends of the spectrum for credit. At this point, we're being relatively defensive in portfolios and looking for other ways to add value, say, through just less liquid parts of the market, but not parts of the market where we're giving ourselves a lot of credit risk exposure. That may have been the good trade in April and May. It looks like a less good trade right now.
Brian, Nick, Chief Investment Strategist at Nuveen, it's been great to have some time with you. We thank you for taking us through the close. But Romaine, you were focusing on perhaps some individual sectors we need to be highlighting at the end of close, and indeed names.
Yeah, well, I thought it was interesting that you did start to see a bid come into some of those large cap tech names. In fact, Amazon and Apple did actually finish in the green, though basically it was flat. They were up, less than 0.1%. But given how much they were down at one point on the day, I thought it was an interesting move to see that you did see some bids come in there. You also saw some bids come into some of those other tech names like Zoom Video, which was up about 1% on the day. Palantir, you had a lot of initiations come in today after that IPO. Those shares were up 5%. And of course, we were talking about this a little bit earlier. Dunkin', obviously that's an M&A play, but a pretty significant move higher there, up 16%.
And Caroline, how much of those stocks that Romaine just mentioned are the work from home trade? You're thinking about a Zoom, you're thinking about an Amazon. On a day, of course, when we
you're thinking about sitting at home eating stuff in your face with donuts.
And that too. And we were talking to Drew Armstrong, where cases not so much important, but of course the hospitalization rates, and that was the number that he was looking at that was a little bit alarming to him. And the stay-at-home trade appears to be back in focus today.
And what gets us the hardest? Of course, it's your travel stocks. I mean, brutal numbers when you're looking at what happened for some of the cruise liners, off by 12 or 13%, Romaine.
But you know what was interesting? I actually went to that American Dream Mall out in suburban New York.
You lived up to your promise?
I was actually surprised how many people were there. So anyone who says retail's dead.
But are they all just buying donuts?
I don't know. Hardly anything was open. But you could go on the rides. You could play Angry Birds mini golf.
Experiential. You're buying donuts. You're not going long.
Yeah. It's only like a few million square feet. I don't know how big.
Don't make me say it.
Are you going out there, Taylor?
It is
muni bonds.
By muni bonds. At the time, the highest junk deal
I took video.
ever.
I'm going to send it to you. I didn't see any muni bonds while I was there.
They weren't on sale? Meanwhile, we're wrapping this up now, of course. That's been the close, but stick with us for more market conversation after this. We're going to be going deep into the various asset classes with Romaine Bostick. Stay tuned. This is Bloomberg. Quick check on the markets because it's the worst day that we've seen, well, basically since the start of October. It was at one point the worst day we'd seen in 7 weeks for the S&P 500. We closed off 1.8% on the S&P 500. Not really any industry group was spared. Industrials were hit hard, energy too. And in fact, it was the stay-at-home trade comes roaring back, Romaine, as we focus in on those COVID cases. Yeah, and this is a busy week for earnings. Kicking off right now with Twilio, sort of the new breed of tech stock out there. Of course, makes a lot of the technology behind a lot of those messaging apps. There are 3Q numbers coming in basically above estimates on the revenue side, about $448 million. The estimate was for $406 million there. EPS was 4 cents. That was based on an estimate for a loss of 4 cents in their outlook. 4Q revenue coming in above estimates, 450 to 455. Caroline, the estimate was for 431 million. And I mean, focus in on Twilio, focus in on what happened in terms of technology, because SAP did it all in terms of Germany, really highlighting that software perhaps isn't always where you're going to be going long at the moment. Clients perhaps put off in terms of their purchases right now. So big fall for SAP. It knocked Oracle, it knocked Salesforce today, but we're also getting individual names and news coming out of some of the banks, say, Taylor.
Yeah, let's take a look at Wells Fargo. They're looking to sell off their $10 billion student loan book. This is all part of CEO Charlie Scharf's plan to cut in order to grow. You want to be leaner and meaner. He has promised to be leaner after years of scandals, really hone in on their key strategy. Part of that now includes selling off a $10 billion student loan book. Talks are still private, of course, but we will bring you news as it comes. I do want to pivot just a little bit and go back over into the world of bonds, you guys, because this was actually a day when, of course, the equity markets are making moves, but then, of course, the bond markets also catching a bid. With more on this, I want to bring in Katie Greifeld, who is our Bloomberg cross-asset reporter. Katie, talk to us a little bit about this 60-40 idea. And I was posing this earlier to one of our guests, where that 40 part of the trade of that portfolio, bonds, it's hard to buy it at 80 basis points. Is that providing the right correlation to some of these portfolios?
Absolutely, and you saw the logic of the 60-40 portfolio really come roaring back today. And in talking to people about just the outlook, it's received a lot of skepticism whether that sort of portfolio mix still works with Treasury yields so low compared to history. But today is a great example of why it does still make sense. It's not so much the starting yield, it's the correlations. And when you have the S&P 500 down 2%, you want an asset that's going to rally, and that's exactly what we're seeing today. That's why Treasury yields are back below 80 basis points after a very, very ugly last week when they sold off on those stimulus hopes. And I'll just point out that if you look at assets such as gold, such as the yen, they're pretty much unchanged on the day relative to the day that we've seen in the equity markets. So again, this is exactly the type of behavior you want from your hedge, even if your starting yield is so low.
And so, Katie, everyone was saying that the 40 in that portfolio now needed to be something other than treasuries, that basically, you needed to find some alternative asset, some hard asset, or even move deeper into corporate credit, even if that meant buying junk disguised as investment grade. What becomes of those trades?
It's a good question. And again, talking to people about what you want in the 40, it's going to be sort of the sedate asset that will provide a buffer for volatility rather than sort of the appreciation that you might want to get out of a corporate bond, out of some of those leveraged loans that I've seen offered as alternatives. And I'll just point to some analysis actually from our own Cameron Kreis. He looked at the 60-40 portfolio, what the European version looks like. And just a reminder that bonds in Europe, their yields are deeply negative and have been for a long time. Yeah, I know. It might come as a surprise. And also, their equity market isn't anywhere near the levels of the U.S. in terms of performance. But still, a 60 portfolio in Europe has returned over 4% this year. So again, even with those very low starting yields, negative in Europe's cases, you can still get a very good return here if you're looking for protection just based on those correlations.
Katie, what did the muted response from gold, from the yen, tell you about today's sell-off?
That's a good question. I think it has to do, in addition to, again, that sell-off that we saw in treasuries last week. You saw 10-year yields get close to 90 basis points, which is the highest level, which would have been the highest level since June. And so when we had the sell-off in September, when we didn't see treasuries react too much in terms of what equities were doing, they were closer to 70 basis points at the time. So the valuations make a little bit more sense this time around, and that's why you're seeing a bid into treasuries, given that we have seen them cheapen up a little bit just in the past week alone.
Katie, it was interesting that last week we were looking at cracks in the short bond trade, where we had been looking at some short positions, looking at the 10-year to break no more than 1%. And then, of course, today that unwound as bond prices are rising. Where are we on short positions?
That's a great question. So you had seen those short positions get built up into the Treasury market. It was the consensus and then some that we're going to see this blue sweep. We're going to see massive stimulus as a result, which will Hopefully, the calculus was generate some inflation. And I wouldn't say that those shorts have been wiped out completely, but this trade had been priced to perfection. There was so much in the price. And I would say the consensus still is in the markets that Biden will have a victory next week, but it's a long time between Election Day and Inauguration Day, and that's a long time to wait for stimulus. So you are seeing some of those bets get dialed back just a little bit here.
Yeah. Katie Greifeld, Bloomberg News, cross-asset reporter, always breaking it down for us. Let's get over to Mark Crumpton with the Bloomberg First Word News.
Romaine, thank you very much. Judge Amy Coney Barrett could be a Supreme Court justice before the end of this day. The White House has a swearing-in ceremony planned for tonight if she is confirmed by the full Senate. Supreme Court Justice Clarence Thomas would administer the oath to Barrett that would put Barrett on the court a week before the presidential election and create a 6-3 conservative majority. She is expected to win confirmation easily. President Trump plans to intensify an already packed travel schedule in the final full week of the presidential campaign. He's expected to hit nearly a dozen states in his effort to recover ground from Democrat Joe Biden, who is leading in most national polls. The president scheduled to hold 11 rallies in the final 48 hours of the campaign. The nation's top infectious disease expert continues to stress the importance of mask wearing and avoiding crowds. In a Journal of the American Medical Association article today, Dr. Anthony Fauci said that is what is needed in our country in order to return to normalcy. Dr. Fauci has said he favors a mask mandate. The United States had more than 60,000 new cases of COVID-19 in the past 24 hours. Residents in El Paso, Texas are being urged to stay home for 2 weeks. Officials are trying to stem a spike in coronavirus cases that has overwhelmed local hospitals. Governor Greg Abbott has also transformed part of the city's civic center into a makeshift hospital and is sending nearly 1,000 medical personnel from across Texas to the region. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
We have some breaking news on the insurer AIG, a change at the top. They are naming the COO, Paul Zaffino, to become the CEO. And the CEO, as stands, Mr. Deperot, will move to the chair. They're also going to be pursuing a separation of the life and retirement business, and they've been naming some key lead independent directors. It looks as though Peter Zaffino becoming the CEO is really this movement of executives at the moment, Romaine, to try and pursue this new breakup or indeed divestiture to a certain extent and separation in terms of their businesses.
Yeah, I think the divestiture of this life insurance businesses, I think a lot of people were speculating on that, though we didn't necessarily know that this was going to happen. So interesting to see them actually move forward with this, and at least based on the initial reaction, Taylor, it does appear investors seem to think this is going to create a little bit more
classic sum of parts versus conglomerate discount, and the executive management in that press release continuing to reiterate, I'm only on paragraph 4 and I've seen it about 3 times, that this is worth more as a standalone business, and they want to create some value by the separation. So that clearly a theme that we see with AIG.
Yeah, big news here in the finance space. Of course, other big news today was the big moves we saw in market. And Taylor, you were talking about this a little bit earlier. The VIX at one point on an intraday basis hitting its highest level since June. A lot of folks out there trading this volatility. Hedge fund managers, they've been all over this for a while, at least one particular one. That's Adam Sender. His Sender & Company partners have surged more than 40% this year through September, and he joins us right now, along with our own Bloomberg Wall Street correspondent, Sonali Basak, to talk about the trade. Sonali, take it over.
Thanks, Romaine, and thank you, Adam, for joining us. You know, you live for days like this, so how do you play a day like today, even on the downside?
Well, I can't say that I was totally prepared for what happened today. As you know, Mondays have typically been pretty strong, and I thought it was already in the market that we weren't going to have a stimulus before the election. So I think, you know, today was a little bit of an outlier and a surprise for me. People are just taking down their books, and there's a lot of nervousness before the election. So I can't say that I saw the saw what was going to happen today beforehand. The breadth was just, absolutely abysmal today.
It was, but we did see some sort of rebound, some gasping for air from the big stay-at-home trade winners. We saw Apple, Amazon almost basically break into the green. These are companies that you've thrived upon focusing on for the year of 2020. With COVID still so rampant, still no vaccine in sight, does the stay-at-home trade still work from your perspective?
Well, we have big earnings this week from Apple, from Amazon, from Facebook, from today, Twilio just came out. So, we're going to get a lot of information this week before, I'm going to make that decision. I mean, it seems like with the glut of information that we have coming up, it seems like the election is like 5 years away, even though it's about a week now.
And as you said, it is just about a week away. What do you envision on November 3rd, November 4th?
It's been so talked about over and over again. I mean, I think coming into today, the consensus was that we were going to have a blue wave. The Senate now looks like there's a better chance for the Republicans than there was on Friday, hence less stimulus. So maybe that's why we had the sell-off today. I mean, I don't think this is going to be like it was in 2016. I mean, Donald Trump getting elected was such an outlier, and that night there was such volatility. I don't think we're going to see that. The only thing that concerns me is basically what really concerns everybody, which is a 2000 type scenario where we don't know who's president for days or weeks. I mean, I think that's the thing that would really crush the market and be a major concern.
So in 2016, you had told me you and your team were up all night, you were trading the futures. What is your game plan for November 3rd?
Well, we'll have a meeting on Sunday and really get to know every one of our states and what we're looking for, and for the Senate races and for the presidency. And we'll watch every single site out there, whether it's 538, CNN, Bloomberg. And as soon as something is an outlier, as you know, futures are open all night long. We'll trade S&P futures, we'll trade Nasdaq futures, we'll trade bonds, because I'm going to need to hedge my portfolio, especially if there looks like there's going to be a hung election.
And so when we talk, Adam, I guess about trading around this election here, I guess the bet at some point has to be where policy goes, where U.S. policy goes, where there's economic policy, trade policy, what have you. No matter who wins on November 3rd or after November 3rd, what's sort of the major sort of policy point that you're keeping an eye on as a trading opportunity?
Well, I think the scariest thing by far is capital gains and what happens there. Last week I always thought that the market would, whether it was Biden or Trump, as long as it was a clean election, we would have a markup of assets into the end of the year. And, now the thing that really concerns me is cap gains. And if we did have a blue wave, would they be retroactive to January 3rd, 2021? I think, that would be something that would be a nightmare scenario where a lot of these high flyers like Amazon, Apple, things that have gone up for the last 10 years would really get smoked into the end of the year, and it would be a major concern.
Adam, talk a little more about that idea of that retroactive capital gains tax. How would that, by the numbers, impact some of these big stocks?
Like I said, what would happen is if you know that the cap gains is going from 24%, 28%, whatever it is, up to 44%, there's a very good chance there would be a lot of pressure on any name that you have a huge gain on. And, basically you could buy that back on January 3rd, anticipating that then if we are talking a blue wave, that we will get some sort of stimulus. But, we haven't done the exact work yet. We're planning on doing it, but I think the tough thing is going to really know what Biden's intentions are if he becomes president, whether he, wants to do that. Other people I've spoken to have said that, the Fed is providing stimulus, and it really wouldn't make sense for them to kind of handicap the economy by raising the.
How are you playing some of these local elections also? Just because I know you're taking a look at that as well.
Well, we're involved in some of the marijuana stocks, so we're certainly focused on New Jersey and hoping that it's passed there. Also, Uber is a name that we're kind of interested in buying, but the clearing event really is what happens in California with this thing that they're voting on and whether it gets passed or not. If Uber and Lyft fail, Uber should get smoked, and then there'll probably be a pretty good opportunity to buy it.
What a fascinating interview, and all the picks around what will be happening before and after the election. We thank you, Adam Sender Company, of course, and partners, and our own Shonali Brasek for helping us bring that great interview. Meanwhile, let's talk about what's happening in terms of these breaking news from AIG, the change in leadership that we need to be keeping abreast of. New CEO, new chairman, but all inherently at the business, of course. The CEO, who had been only joining since the beginning of 2020, moves as the chairman, and the COO of AIG becomes the CEO, but notably, Romaine, it is a moving part of the business in terms of life and retirement and legacy annual. Yeah, splitting those into two separate businesses and potentially two investment opportunities here appears to be what traders have been looking for, what long-term investors have definitely been looking for, Taylor, and now it looks like they got it. And I'm digging through the income statement. The life and retirement unit is about 33% of their revenue. So the general insurance business, clearly a much bigger portion, but again, unlocking that value is something that you hear in about every paragraph in that press release. So we will have much more, of course, on this developing story. And the good news is I'm done in Bloomberg Markets. The closed coverage is done, but what you missed is coming up next. Joe Weisenthal set to join This is Bloomberg.